Most investors never look beyond VOO, and that could be costing them hundreds of thousands of dollars over the long run. While VOO has earned its reputation as one of the greatest ETFs ever created, it is not the highest performing ETF available. Hidden in plain sight are several ETFs that have consistently outperformed VOO over long periods, yet they receive only a fraction of the attention. The surprising part is that these aren't speculative investments or risky fads. They invest in real companies with proven track records and have rewarded long-term investors with even stronger returns. In this video, we'll uncover these overlooked ETFs, compare their performance against VOO, and show you why choosing the right investment could make a dramatic difference in your journey toward building lasting wealth. If financial freedom is one of your goals, this is the video you do not want to miss. And hey, if this is your first time visiting our channel, please subscribe and turn on your notifications so you don't miss our subsequent videos. Your support means a lot to us. Thank you. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. Before we begin the countdown, let's take a moment to understand why this comparison matters. Imagine two investors who each commit to investing $500 every single month for the next 10 years. Neither investor skips a contribution. Neither tries to time the market. Both remain disciplined through market crashes, economic uncertainty, and periods of volatility. The only difference between them is the ETF they choose. The first investor buys VOO and earns an average annual return of approximately 15%, turning those monthly investments into roughly $130,000 after 10 years. That's an outstanding achievement, and one that most investors would gladly celebrate. But now imagine the second investor earning 20% annually instead. Suddenly, that portfolio grows to around $190,000. Increase the return to approximately 23%, and the ending balance climbs beyond $220,000. Think about that for a moment. The contribution amount never changed. The investment period remained exactly the same. The discipline was identical. The only difference was the ETF selected at the very beginning. That's the incredible power of compounding. Small differences in annual returns may appear insignificant at first, but over a decade, those differences can become life-changing amounts of money. Coming in at number 5 is the Fidelity MSCI Information Technology Index ETF, better known by its ticker symbol, FTEC. Although it doesn't receive as much attention as some of the larger technology ETFs, its long-term performance has been nothing short of remarkable. Unlike VOO, which spreads investments across every major sector of the American economy, FTEC focuses specifically on information technology. Its largest holdings include some of the most influential companies in the world, including Microsoft, Apple, Nvidia, and Broadcom. These businesses aren't simply participating in technological innovation, they're helping define it. Another feature that makes FTEC particularly attractive is its extremely low expense ratio. Technology-focused ETFs often charge investors relatively high management fees, but Fidelity has managed to keep FTEC remarkably inexpensive while still providing broad exposure to one of the fastest-growing sectors in the market. Over the past decade, FTEC generated an average annual return of approximately 23.6%, outperforming VOO by nearly 9 percentage points every single year. At first glance, that difference might not sound extraordinary, but compounding transforms those additional percentage points into substantial long-term wealth. That's precisely why many investors choose to complement a diversified portfolio with targeted exposure to technology. Naturally, concentrating investments in one sector also increases risk. If technology companies experience a prolonged downturn, FTEC will almost certainly decline more than a broadly diversified ETF like VOO. For that reason, many investors view FTEC as a growth-focused satellite holding rather than a complete replacement for broad market exposure. At number 4 is the Invesco S&P 500 Momentum ETF, better known as SPMO. This ETF takes a completely different approach to investing. Rather than owning all 500 companies within the S&P 500, it identifies the 100 stocks demonstrating the strongest price momentum and concentrates its investments in those companies. Momentum investing is based on a surprisingly simple concept. Stocks that have been performing exceptionally well often continue outperforming because institutional investors continue directing capital toward the strongest companies. As more money flows into those businesses, their stock prices frequently continue moving higher. SPMO regularly reviews its portfolio, removing companies that lose momentum while adding new leaders that begin demonstrating stronger performance. Over the last decade, this disciplined strategy produced an impressive average annual return of approximately 18.5%, outperforming VOO by more than 3 percentage points every year. Although that difference may seem relatively modest, the mathematics of compounding demonstrate just how powerful even small increases in annual returns can become over 10 or 20 years of consistent investing. Investors considering this ETF should understand that the potential for higher long-term returns comes with the possibility of greater short-term fluctuations. At number 3 is one of the most recognizable ETFs, the Invesco QQQ Trust, along with its lower-cost counterpart, QQQM. Both funds track the NASDAQ 100 index, which consists of 100 of the largest non-financial companies listed on the NASDAQ stock market. While VOO provides exposure across virtually every sector of the economy, QQQ focuses much more heavily on innovative, growth-oriented businesses that have transformed the modern economy. Its portfolio includes industry leaders such as Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta Platforms, and Tesla. These companies have fundamentally changed the way people communicate, conduct business, consume entertainment, access information, and purchase goods and services. Although QQQ and QQQM hold essentially identical investments, QQQM offers a lower expense ratio, making it especially attractive for long-term investors who intend to hold the fund for many years. The reason QQQ has consistently outperformed VOO during the past decade is relatively straightforward. Many of the world's fastest-growing companies have been concentrated within the NASDAQ 100, as cloud computing, artificial intelligence, digital advertising, e-commerce, and advanced software became increasingly essential to the global economy. Many of this unique fund's largest holdings experienced extraordinary growth that helped the ETF generate an average annual return exceeding 20% over the last 10 years. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. Now we've reached the top 2, and this is where the gap between simply matching the market and significantly outperforming it becomes impossible to ignore. Coming in at number 2 is the Vanguard Information Technology ETF, better known by its ticker symbol, VGT. While many investors think of QQQ as the ultimate technology ETF, VGT is even more focused. That's because QQQ isn't actually a pure technology fund. Although it holds many of the world's biggest technology companies, it also includes businesses that fall into other sectors. Companies like Amazon, Meta Platforms, and even Tesla are classified differently within the NASDAQ 100, despite being major innovators. VGT takes a different approach. It invests almost exclusively in companies officially classified within the information technology sector. That means nearly every dollar invested goes toward businesses involved in software, semiconductors, hardware, information technology services, and the digital infrastructure powering the modern world. Its portfolio includes many familiar names, including Apple, Microsoft, Nvidia, Broadcom, Oracle, Salesforce, AMD, Adobe, and hundreds of other technology companies that quietly power the global economy. These businesses don't simply sell products, they provide the infrastructure that allows businesses to communicate, governments to operate, hospitals to deliver care, financial institutions to process trillions of dollars, and consumers to connect with the world every single day. Over the past decade, VGT generated an average annual return of approximately 23.3%. That means it outperformed VOO by more than 8 percentage points every single year for an entire decade. While 8 percentage points may not sound dramatic, during a single year, the mathematics of compounding tells a completely different story. Over 10 years of consistent investing, that performance gap can easily translate into well over $100,000 of additional wealth for investors making regular monthly contributions. Another advantage that makes VGT especially attractive is Vanguard's commitment to keeping investment costs low. Investors receive concentrated exposure to one of the world's fastest-growing sectors without paying the high management fees often associated with specialized investment funds. However, every advantage comes with a trade-off. Because VGT concentrates almost entirely on technology, it can experience much larger declines whenever that sector falls out of favor. During periods when investors rotate into defensive industries such as healthcare, utilities, or consumer staples, VGT may underperform the broader market. That's why many experienced investors don't replace their entire portfolio with VGT. Instead, they often combine it with diversified funds like VOO, allowing them to benefit from technology's long-term growth while maintaining broad market exposure. That brings us to the number 1 ETF on this list, and the difference between it and the others is nothing short of remarkable. The top position belongs to the VanEck Semiconductor ETF, widely known by its ticker symbol, SMH. To understand why this ETF has produced such astonishing returns, you first have to understand one simple truth. Every technological breakthrough begins with a semiconductor. Artificial intelligence cannot exist without advanced computer chips. Cloud computing depends on powerful processors operating inside massive data centers. Smartphones, laptops, electric vehicles, medical equipment, robotics, military defense systems, satellites, and even modern household appliances all rely on semiconductor technology. Without these tiny silicon chips, the digital economy would simply come to a standstill. In many ways, semiconductors are to the technology industry what electricity is to a modern city. People rarely think about them, but almost everything depends on them. Instead of investing broadly across the technology sector, SMH focuses specifically on the companies designing and manufacturing these critical components. Its holdings include industry giants such as NVIDIA, Taiwan Semiconductor Manufacturing Company, Broadcom, ASML, Qualcomm, Applied Materials, AMD, and several other global leaders responsible for producing the world's most advanced semiconductor technologies. Over the last decade, SMH produced an astonishing average annual return of approximately 34%. That figure almost sounds unbelievable. Yet, it reflects what happened as semiconductor companies experienced explosive growth, fueled by cloud computing, digital transformation, gaming, artificial intelligence, and the increasing demand for computing power across virtually every industry. To appreciate just how powerful that performance has been, imagine investing $10,000 10 years ago and simply allowing the investment to compound while reinvesting every dividend. Instead of merely doubling or tripling your money, that investment would have grown to well over $180,000. That's the extraordinary power of sustained high returns combined with long-term patience. But this is also where I want to offer an important word of caution. SMH is not a substitute for diversification. Because the fund owns a relatively small number of semiconductor companies, its performance can be extremely volatile. When the semiconductor industry enters a downturn, the entire ETF can decline sharply. During difficult market environments, investors may experience price swings that are considerably larger than what they would see with a diversified ETF like VOO. That's why going all in on SMH simply because it delivered the highest historical returns would be a mistake. So, the most important question for smart investors should be, could carefully selected growth ETFs help accelerate my journey toward financial freedom? And the answer will be different for every investor. But understanding the possibilities is the first step toward making wiser investment decisions. Now, let me know your thoughts in the comments. Is there any other ETF you preferred over the 5 presented here? Please let me know. Now, if you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Listen, if you want to know the 5 best Fidelity index funds to buy and hold for life, or the 5 best high-yield ETFs for monthly dividends with zero NAV erosion, check out the videos on your screen right now. Thank you, my friend.